Good morning. Thank you for coming to this session. Georgetown University is committed to standards promoting speech and expression that foster the exchange of ideas and opinions. While it is recognized that audience members may not share the same views as the speaker, it is expected that everyone in attendance at this event will respect the right of the speaker and the organizing event host to share their perspectives and ideas, and not cause a disruption to the event's activities. Later in the event, there will be a question and answer session during which you may ask questions. Please be sure to phrase your comments in the form of a question. In the interest of time, we ask that each person be concise and only ask one question.
Good morning and welcome. I'm Reena Agarwal, the Robert E. McDonough Professor of Finance here at the McDonough School and the Director of the Georgetown Pissarro Center for Financial Markets and Policy. I'm absolutely delighted to welcome and introduce Governor Lisa Cook. Governor Cook is a member of the Board of Governors of the Federal Reserve System. She was first appointed in 2022 and then reappointed in 2023. She previously served on the faculty at Michigan State University, and she has held positions at Harvard's Kennedy School, the Council of Economic Advisors, and the US Treasury Department. Governor Cook is a Marshall Scholar. She holds degrees from Spelman College, Oxford University, and she earned her PhD in economics from Berkeley. Governor Cook, we are absolutely delighted to welcome you to Georgetown University and the McDonough School. The last time you participated virtually in a Pissarro Center event was during COVID. This time, it's a pleasure to welcome you in person. And it gives me great personal pleasure, having known you for many, many years, to have you here at Georgetown. And you have joined us at Georgetown many times in the past. So today's agenda will consist of two parts. Governor Cook will provide some opening remarks, and then it'll be followed by a moderated discussion. And we really look forward to hearing her perspective on the resilience and vulnerabilities in the US financial system. At the Georgetown Pissarro Center, we are committed to providing objective, research-driven expertise to support both policymakers and market participants. Amidst the vast array of information that's available, we at the Pissarro Center offer a unique value as an intellectually honest broker, a facilitator, and educator for practitioners, policymakers, and the broader community. Our work is essential in ensuring clarity and objectivity in the evolving areas of finance and policy. The Georgetown Pissarro Center is a leading authority in unbiased expertise at the intersection of global finance and policy. Our impact extends beyond the financial sector. It resonates throughout the global community because a well-functioning banking and financial sector, it's crucial for job creation, for innovation, and for addressing broader, complex global issues. Governor Cook, welcome. We're delighted to have you here.
Thank you, Reena. It is an honor to be back at Georgetown and at the Pissarro Center. I have spent a significant amount of time on this and around this campus, including when I served as a congressional intern early in my career. Perhaps in fate's way of foreshadowing, one of the topics I researched that summer was the Glass-Steagall Act. Turns out that it was handy to learn about it at an early age. Financial stability is a focal point of my attention at the Board of Governors since I serve as the chair of the board's Committee on Financial Stability. Allow me to start by saying that the financial system remains resilient, supported by strong balance sheets among households and businesses and high capital levels across the banking system. Earlier this month, the Fed issued its most recent version of the Financial Stability Report. That report affirmed the system is resilient, while also noting some of the same risks and vulnerabilities we have seen in recent reports. My remarks will center on three areas of vulnerabilities: asset valuations, the structural shift in lending to private companies away from traditional bank loans and toward private credit arrangements, and the growing role of hedge funds as investors in the U.S. Treasury market. Finally, I will turn to a longer-term issue, the potential for use of generative AI in financial market trading that could both increase and decrease financial stability. Let's begin by putting financial system vulnerabilities in context. The Federal Reserve promotes financial stability in order to support the achievement of its dual mandate of promoting maximum employment and price stability. That is, achieving maximum employment and price stability depends on a stable financial system. We know from history, whether the distant past, the Great Depression, or from the recent past, the Great Financial Crisis or the Great Recession, that financial crises typically lead to large job losses and high unemployment. However, given the complexity of the financial system, it is sometimes hard to see the connection between the system and everyday life. Living and teaching in Michigan during the Great Recession, I saw firsthand how the financial system's fragility contributed directly to job losses. One example is how the default of Lehman Brothers contributed, via a chain of events, to declines in employment in Michigan. Lehman's failure in September 2008 led a money market fund to break the buck. The fall in the value of its assets meant it could no longer redeem shares for the $1 that investors expected to receive, prompting a run on the funds. In turn, the funds pulled back from riskier assets, including asset-backed commercial paper. But the major auto finance companies depended on that commercial paper to finance loans to customers, hence they came under stress. With less credit available, auto sales plummeted, and Michigan was hit very hard. Many people, including some of my family members, my students' and colleagues' family members, friends and neighbors, lost their jobs and experienced significant hardship. The Michigan unemployment rate exceeded 14% in 2009, while the national unemployment rate peaked at 10% in 2009. Correspondingly, foreclosures more than tripled in Michigan between 2006 and 2010, and home values in Michigan sank 33% over the same period. I tell this story not because I fear we are on the brink of a financial crisis, but because I think it is worth emphasizing why resilience of the financial system matters for the real economy, a point I have made since writing my dissertation and for everyday Americans' lives. A stable and resilient financial system supports employment and stable prices and ensures families and businesses can function effectively in the economy. This is why policymakers work diligently to understand the functioning of the financial system, and is one reason we publish a financial stability report twice a year. And of course, the story emphasizes the need to maintain resilience of the financial system. With that background, allow me to turn to the financial system vulnerabilities I consider to be most salient currently, beginning with asset valuations. When we evaluate asset valuations, we do not look at the actual levels of asset prices. Rather, we look at their levels relative to fundamentals and whether their levels relative to fundamentals are high by historical standards. As noted in the Financial Stability Report, our assessment of asset valuations is that they are, on the whole, elevated relative to historical benchmarks in a number of markets, including equity markets, corporate bond markets, leveraged loan markets, and housing markets. To be sure, this is not investment advice. I always tell my students about this. You're not in my class for investment advice. I say, you're here to get a grade, not for investment advice. So I'll say that again here. This is not investment advice. Indeed, it is neither my role nor my desire to offer any comment on the merits of different asset valuations. Our role at the Fed is to simply observe that expected compensation for risk is low relative to history, and that might revert, stay low, or go even lower. And situations of elevated valuations are quite common. Asset valuations have been stretched many times since the 2009 trough. I consider any financial system vulnerability through the lens of how it might constrain the Federal Reserve's ability to attain its dual mandate goals of maximum employment and price stability. Currently, my impression is that there is an increased likelihood of outside asset price declines. However, given the system's overall resilience, I do not see the kinds of weaknesses that played out so painfully during the Great Recession, and thus I do not see potential asset price declines as posing risks to the financial system. Another potential vulnerability worth watching is the growth of private credit. Fed staff estimate that over the past 5 years, private credit has roughly doubled. Whenever we observe such rapid growth in credit over such a short period of time, it draws our attention. I use the term private credit to describe loans that are privately held by businesses that originate from non-bank entities. Privately held businesses are companies without publicly traded stock that generally lack access to public markets for debt or equity finance. The growth in non-bank lending to privately held businesses has increased credit access. As a result, private businesses that have difficulty securing a loan from a bank can continue to grow their businesses with loans from private credit providers. In one of its simplest forms, private credit involves a straightforward intermediation chain. Investors with very long investment horizons and no particular need for liquidity invest in a private credit vehicle, such as a private credit fund or a business development company, a BDC, which then extends loans to private businesses. Such investments are usually locked up or ineligible for redemption for 5 to 7 years or even longer. At its best, private credit vehicles conduct due diligence and monitor the loans on behalf of investors. Private credit vehicles tend to have a strong incentive to monitor these loans and can flexibly respond to emerging distress. This careful monitoring is important because private businesses are not subject to the same public scrutiny, auditing, and disclosure standards as their public counterparts. This model has the potential to enhance financial stability and expand economic growth, since it matches longer maturity loans with longer-term funding and allows firms to get the financing they need on favorable terms. Default rates have also been low and returns high. Nonetheless, we should expand the lens and inspect this funding vehicle more closely. We have also seen more complex intermediation chains involving more leveraged players, such as banks and insurance companies, emerge in recent years. Some private firms may also have multiple sources of funding. The increased complexity and the interconnections with leveraged financial entities create more channels through which unexpected losses in private credit could spread to the broader financial system. What do trends in the sector suggest about the potential for such losses and financial stability risks? I do not currently see the potential for private credit to contribute to an unexpected credit crunch in the same way that the asset-backed commercial paper market did in 2008. However, it is well worth keeping a close eye on developments here. Default rates remain low, but they are a backward-looking measure and could reflect increased usage of payment-in-kind arrangements, or PICs, loan amendments, and distressed exchanges. Recent private business bankruptcies in the auto sector also revealed unexpected losses and exposure across a broad range of financial entities, including banks, hedge funds, and specialty finance companies. Should we expect to see more? There are some reasons to interpret the recent failures as outliers. I do not assess the current risks from private credit to be a threat to financial stability. The businesses that failed recently may have been more exposed to changes in trade and immigration policy, made more use of off-balance sheet financing, or been of poorer credit quality than other private businesses. Therefore, it is difficult to infer general lessons from these specific cases. Yet history teaches us a lesson here. The likelihood of observing additional cases like those recently in the news increases when size of exposure and level of complexity in these arrangements are not transparent, when a sector experiences periods of rapid growth, and when these arrangements have not been through a full cycle, boom and bust, of credit. Accordingly, I will continue to focus on ensuring that we understand developments in this sector and how these lending arrangements are evolving over time. Another vulnerability I am following closely is the footprint of hedge funds in the U.S. Treasury market. This footprint has grown substantially over the past few years and recently just exceeded its previous pre-pandemic peak. My focus relates to the potential for transmitting stress to the U.S. Treasury market, which is critical to the functioning of our financial system. As a reminder, the Treasury market is the largest and most liquid financial market in the world. Treasury securities, by serving as a source of safe and liquid assets, enable the efficient and stable flow of capital across the global financial system. The Treasury market averages around 900 billion in transactions per day, with transactions on high volume days around $1.5 trillion per day in recent years. The smooth operation of U.S. Treasury markets is also critical for the transmission and implementation of monetary policy. Hedge funds' holdings of Treasury cash securities, that is, Treasury bills, notes, and bonds, have increased from representing about 4.6% of total Treasury securities outstanding in the first quarter of 2021 to representing 10.3% in the first quarter of this year, just above its pre-pandemic peak of 9.4%. This represents significant growth in the scale of liquidations that could result if hedge funds were to sharply reduce their Treasury positions because of changing market conditions. We witnessed such an episode at the start of the pandemic during the dash for cash, when sales of treasuries by a broad range of market participants increased dramatically and all at once. The sensitivity of hedge fund treasury positions to shifting market conditions depends on the treasury trading strategies hedge funds are pursuing. Staff analysis suggests that the vast majority of hedge fund treasury positions involve relative value trading strategies, of which there are many types. These trades exploit relative price differences between related securities, pairs and combinations of Treasury cash securities, Treasury derivatives, or interest rate derivatives. To be sure, outside of episodes of stress, relative value trades substantially improve the efficiency and liquidity of Treasury securities and related markets. Yet during episodes of stress, the unwinding of crowded positions in such trades could magnify instability in these markets. Relative value trading strategies typically share key features that create potential Treasury market vulnerabilities. For example, relative value trades are highly leveraged to amplify returns from small price differentials, with these trades generally funded with repo that is shorter term than the maturity of the trade, resulting in maturity mismatch. As a result, these strategies are exposed to significant funding risks that could arise from instability in repo markets. Relative value trades that involve derivative contracts, such as the cash futures basis trade and the swap spread trade, are further exposed to margin calls when additional liquidity is required to satisfy increased minimum margin requirements. Such adverse funding shocks can result from episodes of market volatility or from moves in relative prices that are unfavorable to the trade. Sudden funding shocks can then prompt an unwinding of hedge fund positions, resulting in significant Treasury security sales and the potential for market liquidity strains. Increased volatility and losses due to changes in relative prices can also lead hedge funds to choose to exit trades for risk management reasons, also resulting in large Treasury security sales. All of these features of relative value strategies can make Treasury market liquidity conditions and, in the extreme, market functioning more vulnerable to stress. Note that it is not inevitable that episodes of market volatility will induce an unwinding of relative value trades, and indeed, instances of one of these trades unwinding are rare. As you know, the swap spread trade, a relative value trade between Treasury securities and interest rate swaps, experienced an unwinding during April's heightened market volatility because the relative price of securities at the core of the trade moved in ways that became unfavorable to the trade. Nonetheless, other relative value trades remained fully intact. This is especially notable for the cash futures basis trade, reflecting the fact that conditions in repo markets remained orderly throughout the episode. Notwithstanding sizable relative value trade unwindings, sizable relative trade value unwindings remain a potential impetus for market liquidity strains. The potential implications of rapid advancements in AI for financial stability constitute my final topic today. Just as the scientific revolutions in chemistry and biology brought life-saving medicines and more potent weapons, the recent advances in AI have prompted forecasts that run the gamut from utopia to doomsday. How do theory and limited evidence inform us thus far about the potential impact of AI on financial stability? To structure our thinking, I would like to briefly consider one aspect of this question: the use of AI in algorithmic trading in financial markets and the implications for financial stability. Certainly, sophisticated computer-driven trading algorithms are not new. Traders have been using machine learning and other advanced statistical tools for decades. Trading in many important financial markets is now heavily reliant on algorithms. But the adoption of generative AI in trading is different and brings new challenges. Unlike pre-programmed algorithms with limited flexibility, generative AI is able to quickly review large amounts of data and then autonomously deploy trading strategies that could be opaque to humans. Used without careful testing and human oversight, generative AI may create risks that are difficult to monitor or mitigate. The use of Gen AI in trading may also improve on current algorithmic trading activity, especially if the less rigid models prove able to adjust in ways that stabilize rather than destabilize prices. There is early evidence for both. Researchers are only starting to study whether the use of Gen AI in trading leads to more or less correlated trading. Nonetheless, research so far offers some useful insights. Theory and empirical evidence show that independent but simultaneous actions by high-frequency trading algorithms in response to a human signal can indeed generate excess volatility and mispricing, thereby reducing market efficiency. Not all algorithms are created equal. Studies have also shown instances when correlated trading by HFTs improved price discovery without increasing volatility. Research also shows widespread use of popular arbitrage strategies helped eliminate mispricing across fragmented markets. In other words, correlated trading by algorithms can at times also benefit market quality and efficiency. A recent experimental study by Fed economists demonstrates that algo trading strategies that rely on generative AI may also be less prone to herding behavior, by which I mean ignoring private information and imitating others than human traders. In this experiment, the AI agents were less influenced by the cognitive biases that sometimes drive human investment decisions. Researchers have also pointed to the risk that generative AI could engage in collusion and market manipulation, rigging the system to favor those employing the technology. Recent theoretical studies find that AI-driven trading algorithms can indeed learn to collude without explicit coordination or intent, potentially impairing competition and market efficiency. However, others observe that the possibility of collusion rests on the assumption that all traders use very similar algorithms. They argue that algo traders have strong incentives to differentiate their trading strategies because non-collusion can be highly profitable when others collude. Thus, according to these views, the likelihood of tacit algo collusion arising in real-world financial markets is very small. Beyond collusion, there is also the troubling possibility that AI trading systems could learn to manipulate markets. A recent theoretical study shows that self-learning, profit-maximizing algorithms can unintentionally discover spoofing strategies, that is, placing large orders they never intend to execute just to create false impressions of market demand. Potentially, some new AI systems could operate with greater opacity, execute more complex trades, and better hide manipulative intent than old-fashioned, dishonest human traders. Additionally, there are growing concerns that results obtained from complex AI models may be difficult to explain or rationalize by human experts, the black box problem. The inability to fully audit trades executed by algorithms makes surveillance by trading venues and regulators more challenging. The good news here is that major electronic trading platforms are also rapidly adopting advanced machine learning techniques to detect market manipulation and collusive behavior. Thanks to improving surveillance capabilities, AI technology could ultimately strengthen market integrity and enhance market liquidity. Trading venues are also taking steps to mitigate the risks stemming from the black box problem associated with AI enabling trading algorithms. For example, the Chicago Mercantile Exchange recently reminded its members that they must be able to fully explain and reproduce any decisions or actions taken by their algorithms on the CME market. Such initiatives may limit the deployment of generative AI and other stochastic algorithms for direct trade execution on major trading venues. Last but not least, the debate is also growing as to whether the adoption of Gen AI and trading algorithms may increase concentration due to high investment barriers, as seen with one liquidity provider using 25,000 GPUs and building billion-dollar infrastructure, or decrease concentration by democratizing access to sophisticated capabilities previously limited to large institutions. Taken together, areas to watch carefully have emerged, as well as potential ways we will benefit from this new technology. Back to my broader themes, the financial system remains resilient. Yet vulnerabilities from elevated asset values, growth in complexity and private credit markets, and the potential for hedge fund activity to contribute to treasury market dislocation warrant attention. These emerging vulnerabilities also occur against a backdrop of very significant technological change. These innovations may ultimately improve financial stability, but also involve transitions and potential challenges that may require thoughtful and deliberate navigation. My focus going forward will be on working with my colleagues to navigate these opportunities and vulnerabilities to ensure the financial system remains strong and resilient. Thank you.
Okay, now we'll do a moderated discussion with some questions for Governor Cook here. So, um, for our students, it was great how you connected the experiences, what happened with Lehman and 2008, 2010, the global financial crisis, and how it has a real impact on Main Street, right? Because sometimes people forget that finance and stability is so important for
Yes.
jobs. The unemployment rate that you mentioned in Michigan, right? So you pointed out several areas of concerns and just something that you're watching. Where do you see the strengths in the financial system? Right? You've spoken about the vulnerabilities, and so where do you see the strengths? How does today compare from a financial stability point of view to the past? Obviously, the global financial crisis was a complete outlier, but how does today feel compared to the past?
Well, I'll reiterate what I said to begin with, that some positive points are that the system is sound and resilient. And when I say resilient, households and businesses have capital cushions, and they can withstand price declines or other unexpected shocks. So this is something that hasn't been always the case. I mean, you said that we'll keep aside the 2008 crisis, the great financial crisis, but houses and households and businesses are in good position these days. But our supervisory program, for example, is set up to follow these trends very carefully, and the Financial Stability Report characterizes these, the different points of resilience. And we're constantly monitoring. I think that's the biggest part of the Financial Stability Program.
Yeah, okay. The students, a lot of them are business school students, very much interested in what's going on with private credit and how private credit has grown so much. And you talked about that you're monitoring it, and there are some good sides and there are some aspects that need to be monitored. So private credit came into existence basically after the global financial crisis because the banks got out of that business. And to some extent, is that a good thing? It helps diversify risk, and as you said, they can monitor private companies better. So are there some positive sides to private credit? And you mentioned some of them.
Right. So there are always two sides to the story. So certainly we've seen this increase dramatically in the last 5 years. It's doubled. And this is something, any asset class that doubles in a short period of time, we're paying attention to. So on the one hand, yes, banks got out of this business. These companies emerged to fill that hole. These have traditionally been just middle market firms, and they don't have access to capital markets, whether for debt finance or equity finance. So they are filling a gap. And one good thing about private credit is that this is for 5 to 7 years, the capital is locked up. And that means that the businesses can have enough runway to be able to repay these loans and to get the kind of financing they need that they don't have access to. So that's a good thing. But of course, we have many interlinkages. There are firms that are beginning to ask, investors that are beginning to ask, and firms that are beginning to provide more regular redemptions, earlier redemptions, for example, like in the Blue Owl case, or in one firm's case. So this is something that we have to watch very carefully. We welcome innovation of all sorts, but we have to have in place, our supervisory program has to have in place the guardrails that would make sure that the financial system stays sound and resilient.
No, but we, at the Pissarro Center, we did a roundtable on private credit in New York, and we had people from FSB and some other regulators and people from the private sector. And one of the big issues was we don't even know what the size of this market is because the information is proprietary. And then if you try to split up BDCs versus other parts of the private credit market,
that itself is a challenge. How do you get all the data what kind of data do you look at the Fed?
Well, we're always consulting lots of different sources of data. An important one would be the Y14 form that banks have to submit to us. So we can figure out, and they have to report who their counterparties are and so on. So it's these interconnections are there, but we have some sight into them. But we've estimated that this is about a $1 trillion market. So this is huge in the U.S. and large outside the U.S. too, but primarily it exists here. So we have different ways of finding this out. SEC filings, for example. So it's not just data that we receive, but data that are publicly available.
Right. Switching topics.
Did they say anything else that would be useful for us? Like what they're planning?
Yeah, obviously the people from the industry side pointed out all the positives about the private credit market and how it helps diversify risk.
Sweetness and light.
Yeah. So you talked about hedge funds and their ownership in treasuries. I'm going to change topics a little bit, but related to that, what about stable coins, right? Because they're going to be backed by US dollar. And what is good and what's bad there? What are you watching there? Where do you see stable coins going?
So I think, as I've always said, we welcome innovation. Our payments, in my view, our payments have to be faster. I learned this by living abroad. I saw so many places where there were fast payments, and this is something that I would embrace here. And it's happening. Increasingly, it's happening here. So stablecoins provide one way to make these fast payments. And we welcome the Genius Act that lays out the regulatory framework for this. The rulemaking is happening. I won't comment on the rulemaking because it's incomplete. It'll take some time. But this is one way to potentially benefit the entire financial system. Now, denominated in dollars is still, I mean, what exists now is denominated in dollars primarily. But that may not be the landscape going forward. And this is something that I hear from other regulators outside the country, that they're worried about sort of different jurisdictions having their own stable coins and the regulations possibly being different. But that's all to be worked out, but I'm glad to have a regulatory framework that comes from the Genius Act.
Yeah, absolutely. It'll be interesting to see how large this market becomes, how large stablecoins becomes, and especially from a global perspective, the US and what happens in other countries. Going to AI that you touched upon and the algorithmic trading and use of Gen I and how that can cause high correlations and higher concentration. So at the Fed, when you're looking from a financial stability point of view, how do you capture these kinds of issues? And to some extent, they're not quantifiable, like some of the other data that you capture. So how do you look at these emerging risk issues?
So our concern about financial stability is about the way the financial system might be affected, right? So if we're thinking about how algo trading could do that, we would think about, for example, concentration. So this is something I mentioned in my speech, that it could, Gen AI could lead to both increased concentration and decreased concentration. And you're asking how we look at it at the Fed. So we look at it through third-party providers as a supervisory program, but we also look at it through the lens of research. We're actively doing research, say through experiments, to figure out how individual traders might act. And I think this has been really informative, because to find out that herding behavior is not inevitable. I mean, I think I always thought it was from, you're the expert in finance, I'm just a macroeconomist, I might be overstating the case, but it seems like that would be inevitable, but it's not. If you use Gen AI instead, it can pick up or avoid some of these cognitive biases that human traders might have. Now, of course, there's the black box problem. It has to be explainable. This is what the Chicago Mercantile Exchange is saying, that you have to be able to explain this. And there's litigation, insurance, other institutions that are asking for explainability. So that's going to be an unavoidable problem, I think, going forward.
Interesting. So, Governor Cook, you've been a professor for most of your life, and now you're a Fed governor, and we have a lot of students here. Help them understand, what does life as a Fed governor look like? What is all the information that you're getting, and how do you use that information for your decision-making purposes?
So I think that's a really good question. I'll start with my first impression in the first weeks at the Fed. People actually read your work. So, if I publish something, maybe there were 10 specialists in our field who might read it, and then like 2 of my relatives who may. So, this is very different, and these decisions are incredibly important, and I think you feel that from the time you walk in the door. So, what I am really amazed by is that I've had to use every part of my training as an economist, and including my internships, say, working at an investment bank and figuring out how to analyze companies so I can understand the microeconomics of what's happening, including all of my stints at financial institutions. Those have been very helpful. I have also had to use my knowledge of large data sets that I really learned to use when I was at CEA. So these data sets are fantastic. We just got the employment numbers today. I think many of us realized, we realized that, we knew that, but many outside the Fed realized how important official data are during the shutdown. So we get labor data from BLS, we get CPI data from BLS, we get GDP data from BEA, I mean, from all of these important sources. And before each FOMC meeting, we've got to figure out how to put these together to be able to meet the objectives of our dual mandate of price stability and maximum employment. What's the story? And we don't just believe the data, because we receive a lot of aggregate data. We have to have the mortar between the bricks to be able to understand what the story is. So we talk to a wide range of people we interact with in the economy. So financial institutions, firms, nonprofits, households, about how they are doing. We collect information through surveys. We go out and talk to them directly. That's some of my most interesting engagement, is with firms and with individuals prior to an FOMC meeting. We learn a lot. So it's, in that sense, just the weight of the world, yes, is on your shoulders. At the same time, you have access to vast amounts of information, and it's your challenge to put it together in a way that helps the American people and American businesses.
Well, of course, thank you for your amazing service, your public service, and the weight on your shoulders. We are absolutely counting on you. I have tons of questions I can go through, but I want to make sure that our students get to ask some questions. Mm-hmm. So we will go to student questions. If you will, we have mics that can come around. Okay, let's start here.
Governor Cook, thank you for being here with us today. I'd love to follow up on the conversation of AI in financial markets. Yeah. Given the rapid rise of...
Please, can you tell us your name and
Sure.
You're a senior, right? Yeah, tell us a little bit about yourself.
Sure, I'll introduce myself before I ask the question. I'm Rohan Mistry. I'm a senior here in the MSP. I'm studying finance and business analytics with a minor in statistics. Mm-hmm. And on that conversation of AI and trading, I'd love to understand how the Fed is potentially preparing for increased volatility as AI is increasingly used in these trading systems, and what the Fed is potentially doing to prepare for, that increased volatility, especially during those stress events.
So let me start by saying that all volatility is not problematic. I mean, some volatility is useful so that we understand market conditions, right? So you wouldn't want all volatility to go away. You wouldn't want it to increase dramatically. You wouldn't want it to impede market functioning, but it's not all bad. All trading strategies, as I was saying, are not created equal. So what we're doing is what we typically do in our financial stability program, and we're always thinking about the future. This research that I was telling you about that investigated this experiment that investigated algo trading was meant to try to understand how market participants behave, and if this would lead to some breakdown in market functioning, if it would increase market functioning, and that's part of our approach. But what we try to do in the financial stability program is to think about the tail risks, because the last crisis is not going to be like the next crisis. So you have to think out of the box. You have to be curious about the other things that could happen. So an experiment is going to highlight some of that. And it's just one, but we're doing a lot of research related to Gen AI.
Can we pass around the mic? Okay, there we go.
Hi, Governor. Thank you so much for coming to speak to us today. My name is Isabella Terry, and I am a senior in the School of Foreign Service studying global business and minoring in German. My question today is we focused a lot on vulnerabilities, and I know the Fed's most recent stability report highlights that short-term financial uninsured liabilities are reaching really high levels, especially in comparison to before the Great Financial Crisis. So I'm wondering how much of a threat is this, and if so, how can the Fed counteract it? Thank you.
So I think that's a really good question. I think one of the major vulnerabilities that I think about is something I mentioned in the speech, and that was maturity mismatch. That the funding, say in the treasury, in the hedge fund strategies that I was talking about, the relative value trades, that depends on repo financing, and that is shorter term, typically shorter term than the trade. And there are many different types of relative value trades. So this is something that we are concerned about, and because this has increased, the hedge fund's footprint has increased so much in a short period of time. This is something that has come to our attention, so we're watching it very closely. But I think in general, we think about where, again, the next vulnerabilities might be. Not where they necessarily are today, but where they are going, and what other vulnerabilities could arise as a result of short-term funding, for example.
Okay, I'm getting the signal for we should end Q&A. Let's take one last one here.
Hi, Governor Cook. Thank you so much for coming and speaking to us. My name is Ethan Palusak. I'm a sophomore in the business school studying finance and operations and analytics with a minor in statistics. And so every financial cycle seems to reveal new blind spots. Looking ahead, what kind of vulnerabilities are keeping you up at night, but that markets and policymakers might be underestimating? Thank you.
So I'll start by saying that the system is sound and resilient. So, nonetheless, I would say that as chair of the Committee on Financial Stability, everything keeps me up, like everything. Algo trading keeps me up. I mean, given the reasons that I stated, but there are many vulnerabilities that we outline in the financial stability report. But keeping me up doesn't mean I'm just worried and that is unidimensional. It is multidimensional because you want to be able to predict what might happen in the future, and that's why we look at tail risks. So there are always blind spots, and we're trying to cover them, and we consult not just Fed economists. I told you about this experiment, but we're looking at other academic work. We're looking to other experts to help us uncover these vulnerabilities, these risks, and then how resilient the system might be, the vulnerabilities, how resilient the system might be to those risks. So we're always looking. So everything should keep me up at night, absolutely. Yeah.
And since you've mentioned the financial stability report several times, maybe for the benefit of the students, if you might mention who serves, you chair the committee, who serves on the committee?
Other governors serve on the committee, but this is heavily run by Fed staff. So we have a financial stability program. Andreas Leonard is the person who's been at the Fed working on financial crises since the great financial crisis. We have a lot of deep expertise in that area.
Fantastic. Thank you so much, Governor Cook. Please join me in thanking Governor Cook.
Thank you.
That was great.